just give me a sentiment check on these markets. We have Fed officials issuing some caution here about the prospect of cutting rates too soon, and markets seem pretty happy to rally through it.
Thank you very much, Dan, for having me on the show. Yes, I think from the Fed point of view, that's part of the plan. They will continue to be hawkish until they cut. And it has been a major change. If you see it from the last year, we were expecting like 6 rate cuts, and now we are okay with the 3. And starting with June. But then Fed has repeatedly said that they will be data dependent. And if we look at it, from now till the June, there is going to be 3 CPI prints, 3 job prints, and the transition that the Fed wants the inflation to be around 2% will be a bit of a bumpy. So we'll have to keep in mind what kind of data we see, and PCE data that we are going to see is going to be an important cog in that wheel. That if we are going, let's say, above 2.93%, then there is going to be a bit of a concern. But I think we are seeing that PCE is much softer than the CPI. So let's see how the data comes up. But we still feel that, yes, there'll be some kind of a rate cut, and Fed will continue to have the language of a bit hawkish till they actually cut it.
Indeed. And look, walk me through the next data point that we were just discussing. The PCE number is going to be very closely watched. Is it going to confirm that rates may need to stay higher for longer?
Again, that's where I think we have to sort of compare, because PCE is the Fed favorite sort of indicator on the inflation, and if it surprises us to the negative, yes, the Fed will go to it, because they would like to have that kind of a legacy that they were able to tame the post-COVID inflation, and then they will go towards being more sort of a data dependent. And we have to see how the job market and the overall the growth numbers, and how much growth can we sacrifice with the kind of the inflation and with the kind of high rates, higher for longer trend. But we still feel that we will see some kind of a tackling of the inflation. I think Fed has done a decent job, but the path to 2% will not be that easy.
Faisal, just before I let you go, waking up this morning, looking over what is clearly the world's best business news website, CNBC.com, no argument there. Excellent article on the question of whether or not we can see markets move higher here. And this piece that asks, is it time for investors to hedge a market decline? We're seeing record highs on Wall Street. Asian markets seem pretty happy to top some recent gains as well. Walk me through what to look out for from here, and should we be looking at a potential pullback in the markets given the run-up that we've seen?
I think now we are probably entering another earnings cycle. So the corporate earnings will be a very major part that we will be looking at, because the earnings growth has been good, especially led by the tech sector. The cash flow generation has been good. The valuations have been slightly stretched, but they are not sort of totally over from the historical benchmarks. So again, the corporate earnings that are coming up will be a key in order for the market to see where do they go next. And it will be the broader corporate earnings, because we saw in the last earnings, the tech has sort of beaten the estimates around 89% as compared to 77% on the broader market. So that will be a key area that we need to look at. And how does the currency markets move, especially the strength of the dollar remains, and how does that move is going to be an important